Are less than 2 weeks away from the election, and investors should be gaming out how the results could impact your portfolios and the broader implications for trade policy, tariffs, and the deficit. Joining us now is Neuberger Berman President and Chief Investment Officer Joseph Amato. Joe, good to see you. So tariffs, taxes, regulation. Let me start with taxes. Depending on we get a President Trump or a President Harris, how do you look at your portfolio and decide what shifts you would make in a tariff situation?
Well, from a tariff standpoint, that's going to be a hugely important issue. We think by the time, if a Trump presidency occurs, it'll probably be more later in 2025 when tariffs actually get implemented. Our view is that the 60% number for China, the 10% across the board is a negotiating starting point for Trump. And if you think back to 2018, the list of products that were supposed to have tariffs was quite long, and then what actually got implemented was much more narrow. So it's going to be something that we're watching closely. But certainly tariffs broadly are going to be inflationary. If you look at the basket of products that had tariffs in 2018, they were probably up 3 to 4% a year after the tariffs were put in place.
What kind of impact would that have, particularly on Chinese stocks, you think, and then on EV and energy stocks that I guess, hypothetically, would benefit?
I think there's been so much talk of tariffs. I think the market is assuming that there's going to be some level of tariffs, and I think the betting markets right now are expecting a Trump presidency. We'll see. It's clearly going to be close. But those products that end up getting applied are going to have real impact there, right? It's hard to determine now because of the nature of Trump administration's approach is very transactional, so it's very negotiating. So if they are able to cut deals with certain industries or companies, right, you're going to have less tariffs, and that's going to impact those companies less. So it's unfortunately a bit of a wait and see approach, right, in terms of what exact companies or products ultimately receive tariffs.
Joe, I'm going to ask you the same question we asked our market guests earlier in the hour, and that is the fact that you have seen yields move higher in the last couple days, couple weeks. What is it signaling here? Is this gaming out perhaps a more restrictive Fed policy moving forward if economic data remains resilient, or is this more about perhaps greater worries on the horizon like deficits and fiscal policy?
I think, Morgan, it's a combination of both of those. I think certainly the economy has proven to be more resilient than one might have expected a couple of months ago. So the expectations of Fed cuts is less than it was going back, a month or two ago. GDP now number is in the mid threes. That's a pretty strong performance from an overall economic standpoint. So that would push yields higher on the long end in particular. And certainly as Trump has improved in the polls and the betting markets, if you will, have leaned into a Trump victory, I think generally, if you could drill it down to two simple things. Trump's president, it tends to be probably more growth, more inflation. If Harris, it's probably less growth, less inflation. So as Trump moves up in the polls, I think the market's going to assume you're going to get potentially a little bit higher inflation.